Whoa, I unmuted myself. What is up, everybody? And welcome back to Cryptographics. And welcome back to the Age of Taurus and the Age of Unity. Man, it is good to be back again. And this stream is happening again today because we had a little bit of an error on, I believe it was Wednesday, the last time we streamed. So if you noticed, if you were there for that, that stream is no longer up. So we are doing another stream today, which is going to be slightly different than the last one. I want to flow a little bit differently. I want this to be mainly a Q&A today, but we are going to talk about what we're seeing within Taurus and Unity, because there's always lots to talk about. There's always really cool learnings that we can dig into, dive into, and explore together, because there's so much to learn in real time between these protocols. And again, if you're unfamiliar with Taurus, if you're unfamiliar with Unity, let me just check to make sure I'm not clipping. I'm going to turn myself down just a little bit here. I'm a little loud. And what I want you to understand is Taurus and Unity are both identical systemically, meaning they are the same systems, but they are two separate versions of the system that I have designed, and they are built on Ethereum and Pulse Chain independently of one another. Now, Taurus and Unity are also built on top of two tokens on Pulse Chain and Ethereum. On the Ethereum side, Taurus is built on top of a token called TitanX, which is a hyperdeflationary token. And Unity is also built on a deflationary token. Could even say hyperdeflationary token, though it's more deflationary than hyperdeflationary, on Pulse Chain called Pulse X, or PLSX. So these systems are both on different chains, leveraging different chains and their value propositions and tokens and their value propositions, and also different communities, which makes them both very independent of one another and very different animals. So what these are designed to do, though, is solve the problem of people, users, people that want to use their assets to get more of their assets, to grow their portfolio, but be able to do it in any market. That is the point of Taurus and Unity. It is as simple as that. This is an asset that gets more and more difficult every single day to earn. You must deposit fees or deposit tokens in order to earn this token, which goes back to supporting this token. So, in a nutshell, I want you to imagine that there's a company, and in this company, you can buy shares directly from the company. When you do that, you must lock up these shares for up to 88 days. And when you do that, you're going to earn more additional shares. Sounds pretty sweet, right? Well, let's take it to the next level. What if when those shares were done their lockup period and you got both the shares you purchased as well as the shares you earned back, you could take all of those shares and lock them up again with the company by paying a small deposit to continue to earn more shares. This would be something that most people, I think, would want to get involved in. Imagine if you could do this with something like Amazon, where you could buy shares for the company, lock them up, and then earn more shares over the course of the next 88 days, and then lock what you've earned up plus what you bought originally up again for another 88 days, all while it getting more and more difficult to earn shares from the company. But the costs of earning are constantly going up, which means this company is able to support itself to go and do what it needs to do to raise its own value over time. I think most people would agree that's something they want to at least pay attention to. And that's what we're doing here in a nutshell. It's one viewpoint, one perspective of what is happening with Taurus and Unity. These are truly the first of their kinds that allow people to use and leverage market conditions, high prices or low prices, to gain more shares, which is unique to Taurus and Unity and has never been done before, all while earning from the same source within, in this case, the protocols, and in our analogy, the company, right? You're leveraging high prices and low prices to gain more shares in the company. And that is what Taurus and Unity are trying to do. They're very similar to BTC in that sense, of their asset and how it inflates over time and the scarcity that is built in to the asset. Anyways, enough about that. We've spent 5 minutes talking about what we're talking about here. So let's get in. I want to welcome everyone that is here so far to the stream. I see Cash. Thank you so much for being here. As always, Cash is a legend in our community, in the Taurus and Unity community. And I also see Pulse Chain Info here, which is great. Mr. Martin Max King, again, another legend in the community. And I have definitely seen these three roaming in our comments the last couple streams. It's great to see some consistency here. And again, before we get going, please, if you haven't already, repost this on your favorite social media platform and let people know that we're live. Let people know that Unity and TORUS are rocking and rolling, and bring them out if they want any questions to be answered, no matter how difficult they can be. Okay. We actually had an interesting space yesterday, thanks to Kesh and Martin. And it was a pretty amazing space. We had someone come on stream, not on stream, but in the X space, and fairly upset about the way that things were going for them with their experience of TORUS and Unity. And it turned out to be a pretty amazing show of character for all the people that were in the community, and it felt like something special was happening there. So this isn't just any community. This isn't your typical we're all here to make money and leave community. There's something different happening here. And if you are looking for a breath of fresh air in this space, this community is definitely that very thing. Everyone wants to make money. We're not going to deny that, oh, we're different, we're not here to make. That's not true. Everyone is here for the same reason of changing their lives. But there's a depth to this community that I'm seeing emerge that is unlike anything I've ever seen before. And I could not be more thankful for it. So this is the place to be. Welcome to the age of TORUS on Ethereum, and welcome to the age of Unity on Pulse Chain. And we will get going into what's happening in these ecosystems right now. Let me just welcome Mr. Gunnerboat. Let's go. And Suel, welcome. And let's get into it. So I want to start talking about what's been happening with the prices, and I'm going to relate what's happening with the prices to what's happening systemically here within TORUS and Unity. We're going to start with TORUS at the moment. So let's go over to, the price chart, and we are going to talk about it. So TORUS right now is quite a spectacle. And I'm always going to be biased. I'm always going to say that, but it is to me. When you go from creating something on paper to building it, and then it finally, after over a year and a half of building the damn thing, goes live, every aspect of it is intriguing. Every moment of watching it evolve and people interacting with it, and it going up and down in price, and tokens deflating, and there's just so much to watch and learn from that. To me, at least, it's incredibly exciting, especially when it is performing better than it was designed, and you see so many people actually seeing benefit from it. So what's been really cool for me to watch is, and I'm sure for many of you too, is the journey of starting at a few dollars, going up to 12, and watching us come all the way down to around 6 cents, which has been pretty crazy. And all the while, the liquidity, this is one of my favorite things to watch here. And I say this in relation to Unity as well, because Unity is going to go through a similar phase, and it's currently going through its own part of the journey that TORUS went through, which is seeing liquidity go up to $200,000-$300,000. And then as price drops, liquidity drops with it. The price gets more volatile. And then we find a rough area where a bottom begins to occur. And then the buy and build for TORUS was turned up to create a price floor, so to speak, or a liquidity floor. And what's happened was we went from about less than $59,000 in liquidity around this range, around 8 cents, all the way up to $200,000 in liquidity with only a $700,000 market cap, meaning the value of all the tokens that are staked and liquid right now, whether they're in people's wallets, in a liquidity pool, or they're staked, are worth $712,000. And the total liquidity is $196,000. That's like 3.5 to 1 liquidity to market cap ratio. And if we were to go look at any other token, the ratios are completely different. Let me put this into perspective for you. I'm going to bring up the market cap for some favorite Pulse Chain tokens, and then we're going to look at the Titan X tokens as well. So let's look at Pulse, for example. We have $539 million market cap. And if we go to, actually, let me bring up Pulse X here, because I need to bring it up so we can see the liquidity as well. Actually, does this have, I wonder if it has, I'm not super familiar with what's happening with GoPulse anymore. I kind of just use them because of how easy it is to see the market caps and everything. But let me bring up, and I know I'm not sharing it right now. I will in just a moment. I'm going to go to Pulse X, and we will dive into just how much liquidity there is here. So, okay, here we go. So on Pulse X V1, right? If we include V2, it's a different story as well. But between V1 and V2 on Pulse X, Pulse has a total of, it looks like 28 million. So we've got 12.35 million in liquidity here, as well as, and that's in V2 and in V1, 16.75. So basically, we have close to about $19 million in liquidity for Pulse. Now, if we go back to GoPulse here, so let's go back here, we can see that we have $539 million in market cap. Okay, so what this means is if we do some quick math, and they say don't do math on stream, but this is simple enough where it shouldn't be an issue. Fingers crossed. Do your due diligence when I'm doing this math, and just double check this for me, because you know how it is when you're trying to be thorough in front of someone or a group of people, and your thinking can get a little skewed as you go a little bit too quick. So you guys can't see the calculator that's on my screen, but if we go, what did I say was 19? So if we go 539 and we divide that by our 19 figure, we get 28 to 1. So for every $28 in market cap of Pulse, for every $28 in value of Pulse, there's a dollar backing it. Okay, that is, or actually, it's actually twice that, because the total liquidity in V1 and V2 is 50% Pulse, 50% actual dollars. So if we actually want to do this right, we need to double this. So we can take this number of 28.36 and we can multiply it by 2. And we get a market cap to liquidity ratio. So dollars backing the total market cap of every $56, $56.7 of Pulse is backed by $1. Okay, so that's our ratio. Now, let's come back to TORUS and we'll do the same. We'll imply the same in the future for liquidity for Unity, because Unity is still, as we can see by sharing this here, Unity is still going through its phase of, I would say, distribution in its initial cycle. And this is what TORUS did. This is what Unity will do as well. And we will see this change, though. And even despite that, we could, and I don't really want to, because it's kind of a false representation of where liquidity and market cap are right now, as the market cap is still going to expand, meaning tokens are still going to come out pretty dramatically over the next 14, 15 days or so. So we will more so look at TORUS, because TORUS is a better and more accurate representation of what this system is able to do after it's gone through its initial phase of, say, supply release, its first 113 days or so, actually 114 as of right now, as of 17 minutes ago. So if we are to do the same math with TORUS, so we do 711 divided by 196, we get 3.62. And if we multiply that by 2, we get a factor of every $7.25 is backed by $1. Remember, that's a little different than $56. So typically, if we, like, I think the post I did, oh God, this was last year sometime. If you go look at the market cap to liquidity ratio of all the major tokens, coins like Bitcoin and Ethereum, they're in the 40s, in the 50s, in the 60s, in the 70s, even in the hundreds of dollars being backed by $1 in market cap to what is available in liquidity. So for us to be sitting here with $196,000 in liquidity, or, we go look at the Titanx backing, $97,000 in liquidity with $711,000 in market cap, it's a pretty supremely high ratio of liquidity to market cap. So, excuse me, dry throat. And the reason I bring this up is because this is one of the most important things to pay attention to and how this will scale over time. I know I spoke about this in the last stream for those of you that were there, but I do want to hit this on the head again, because it is one of the most important aspects of TORUS in Unity. Why? Liquidity is king. if you cannot enter or exit, or if your liquidity, meaning the dollars that are within the market, meaning the dollars that are in the liquidity pool, the container that allows you to trade between Taurus and Titan X or Unity and Pulse X, if you do not have deep enough liquidity, or there's not enough tokens in those containers in the market, every buy and sell impacts the price tremendously. So volatility is higher, meaning it's very hard for, let's say, someone actually really likes these protocols. There's $10 in liquidity, and someone wants to buy $100,000 in tokens. Impossible. They just can't do it. If they're going to buy, I guess it would be $5 in liquidity, they would 4x the price. I'm not going to explain the math behind that just yet. We might get there, but this is how things work if you don't have liquidity. So it's really important, especially for a protocol like this, where or like these, where Taurus and Unity operate. Oh my goodness, look at these lines. Let's delete these because these look hectic. When we are talking about how these systems work, they operate around a ratio over time, right? Like when Taurus and Unity first started, they had their initial ratio of 10 million to 1 for Taurus and 100,000 to 1 of Unity to Pulse X, or Pulse X to Unity, sorry, initially. And over time, what we see is we had this initial 10 million to 1, which is right here. And this will go up over time ever so slightly. And if we were to zoom out and project this over the decades, we would see this median ratio doing this against Titan X. Now, the reason this is important to understand is because if these systems have low liquidity, well, then the price can go way up and way down and be volatile, and you never really know what's going to happen. There's no stability, right? It's unpredictable and it's all over the map, and it doesn't really allow the protocol to operate smoothly. And when I say smoothly, that means to have, more predictable market conditions that allow people to actually grow their portfolios in Taurus and Unity using this system. So what the point of thick liquidity is, and the benefit of it for Taurus and Unity, is that even if it takes us a while, and obviously we're talking through the range that I'm drawing here, this is a year and a half or so. Let's say it's a little shorter. Let's say, as quickly as we came down, we took twice as long to go back up to our ratio. And this ratio, again, is for when creating is actually more profitable than staking. So when we get to this point here, thick liquidity, deep liquidity, a lot of liquidity, more numbers, more dollars in liquidity, more dollars backing Taurus in its market, means that there is less chance that a single sell is going to push the price down in one shot, which means smoother operation around this median point at all times. This brings a huge amount of benefit to liquidity providers, to the way people are going to view the system. And we may not see it be as smooth as this. I cannot imagine it's ever going to go perfectly to plan. I've already learned that from my initial expectations of what I thought Taurus and Unity were going to do. So I will also superimpose that onto the future, meaning it's not going to go how I think it's going to go. But what we can expect here, in my opinion, is that if we can grow our liquidity down here, by the time it gets back up to this range, we should have, potentially, if we look at how many X's is this going to be here to go back up. So about 16X. Okay, sweet. So we know that the liquidity is going to double and double again, because for every time the liquidity on the buy side doubles, so on this side, we get a 4x in price. So we can presume that the liquidity is going to double on our first 4x, and it's going to double again to get us to about a 16x, which is going to bring us to $800,000 in liquidity at those prices, roughly. If we can grow the liquidity at these levels to 250K, now we're talking about $1 million in liquidity by the time we get above that ratio. And at that point, man, $1 million in liquidity is a fairly stable amount of liquidity, which means larger players can enter and exit, people can compound more, people can grow their own bags more, and it takes longer for prices to rise and fall, meaning there is more opportunity over longer periods of time for people to actually use this system to take advantage of it. So I just said a lot. Again, there's my monologue, and we haven't even really gotten started yet. So let me go and check in with everyone again. Good morning from Australia. Todd, welcome. What's up? Thank you for talking today. Mad respect for you, graphics. Hey, my pleasure. I do want to stream and talk to you guys more. That is definitely on my agenda. I just want to make sure that it's, I'm not falling into a more journalist approach, which, I learned for myself is not the healthiest for me. So appreciate you being here. It's always great to have you. Kesh, question on V3LP. For perpetual fees, a full range is better than custom range, right? I am a newbie too. I am 66% Pulse Chain, 33% is Torus. Do I help other people trade Torus if I provide liquidity? So great questions. Great questions. With these systems and providing liquidity, for perpetual fees, a full range is better than a custom range, right? Let's talk about this. So better or worse are words I want you to stop using in this scenario. I want you to think of decisions or ranges as more or less appropriate and more or less risky. Okay. So when you provide liquidity in a full range, meaning, when you have, and I'm going to bring boxes here, when you provide liquidity, meaning you are allowing the market to buy and sell the Torus and Titan X, specifically to Torus, and the Unity and Pulse X that you provide to the market to be used, what is happening here is on full range, which is just you provide liquidity and the market's allowed to do what it wants to do, means that your Titan X that you are providing is going to essentially cover the entire range of possible prices that people could essentially sell into. Meaning when someone says, I want to sell Torus, they're depositing Torus into liquidity and they're taking out some Titan X. And so your Titan X is going to cover the entire range. And on the flip side, the opposite is also true, where, and I'm going to change this color here to, let's do green. And we'll change this one to red just because it's a sell side. So this is our current liquidity setup on full range, which means, and let's actually just bring this up higher because it's infinite. We'll just leave it there. So when we go from where we are now, higher or lower in price, we go higher and lower in price because someone is saying, I want to buy or sell Torus. And when they buy or sell Torus, they are either, if they're buying Torus, they are depositing Titan X into the liquidity pool and trading that Titan X for Torus. And that move actually increases the value of Torus, right? So price then moves up. The opposite is also true, where if you deposit Torus into the liquidity pool, right, then you are taking out Titan X, which is devaluing or lowers the price of Torus. So what this means is, for you guys that want to liquidity provide, is that there are risks in given phases of the protocol, right? If you want the least risk possible, right, you are going to want to provide full range because you have zero risk of having all of your tokens basically taken from one side of the pool, unless you see the price go from basically where it is now to zero or to infinite, right? What that means is, if you're providing, let's say, $900 or $1,000 and $500 in Torus and $500 in Titan X, if the price goes all the way down, right, you're going to basically be left with only Torus and very, 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 very little Titan X. And if the price goes all the way up to infinity from here, you're going to be left with virtually no Torus and all Titan X. But the whole way, people are going to be trading your Titan X and Torus tokens all the way up or all the way down, meaning they are going to be utilizing your tokens and you are going to be earning fees that entire time. This is great if you are expecting volatility within a given range, right? So if you are expecting volatility, where's my drawing guy here, my brush? If you're expecting and you don't care, this is the thing as well. If you don't care about the tokens you're holding, but you just want to earn fees and you know that price is going to be volatile, it's going to go any which way in any magnitude of volatility, meaning extremely high or extremely low and anything in between, full range is a great way to just earn fees regardless, right? It's just going to print you some fees depending on the amount of volume. Now, where this becomes kind of a lackluster strategy or a lackluster use of funds, and obviously there's risk that we're going to talk about here as well, is when you have a specific range that you believe that a token is going to exist within in terms of its price to what it's paired with. So for TORUS, this is extremely important to understand in where we are right now. We are below the median ratio at which this system is going to try to operate and want to operate around over time. And this ratio is going to go up over time. So right now, we're in the phase where volatility has been and probably still will be a part of the game. It may still be in the future as well as this system evolves and matures and grows. But right now, volatility is the name of the game. So what you have the option to do with V3 is actually provide liquidity in a tightened range, which means you can provide TORUS and Titan X for or within a specific set of price parameters, not just the entire range, meaning there is limits to where your tokens will basically be able to be traded on the market. And this concentrated effect or concentrated liquidity that you can do actually gives you an enhanced effect on, let's say, how buys and sells affect the price. When you compress the tokens that you want to put into a smaller range, it acts as, say, thicker liquidity. So because it's more concentrated to a small area, it is acting as though the liquidity in that range is, in fact, deeper. And what happens, though, for you as a liquidity provider is when you go from, let me just bring this here. Actually, I'm going to go and make this little trend line. So we're going to make this line nice and thick. And I'm going to change this to as thick as possible here. So our blue line is where the price is at. Okay. So what happens is if the price here, and I'm just going to make this even a little wider just to make this real easy to follow. So we're right here with the price. Okay. We're right in the middle. Now, or we're right, the price is right in the middle of our liquidity that we've provided. What happens though is, remember, as the price moves up and we've provided liquidity in this range, what that actually means for our position is that people are buying TORUS. So they're removing TORUS from our position. They're buying into the TORUS that we have provided, and they are leaving Titan X in the pool. So as the price goes up, closer to the top of our range, we are left with more Titan X and less TORUS. Now, this, in terms of fees, is much better because it takes more volume to move through our range, and we can stay in this range, meaning there is more volume that we are earning from in this range. But what happens is if the price moves above this range that we have here, completely out of it, where we've said this is our top, this is our bottom for our max, where we are going to have our funds being used, now we are completely out of range, meaning all of the TORUS in our range has been purchased and we have no more TORUS in our range. We are only left with Titan X. And since we're only left with Titan X, we've basically we consider that we've sold all of our TORUS, or we have lost all of our TORUS, and we are now no longer earning fees because the price has gone above our range. So this is called impermanent loss. Now, it becomes permanent when we decide to remove our position. but it is impermanent if the price goes up and we begin to come back down into range. Okay, so if we don't move our position, we go all the way up here in price, we are left with only Titan X, but we don't panic and we don't remove our position, and the price comes all the way back down to right where it is. It's as if nothing happened in terms of we are still going to have the same amount of Taurus and Titan X that we began with, but we will have earned fees in the process. Now, if we had gone and taken out our position up here when it was out of range, we would actually be left with only the Titan X in this position here. And if the opposite was also true, where the price went low down below our position, we'd only be left with Taurus and all of our Titan X would be removed. And we would now no longer be earning any fees because the range that we provided liquidity for is up here and the price is down here. So this was a lot. I know I've gone through quite a number of different aspects of this, but for you that are curious about this, I would recommend re-listening to this, re-watching, just thinking about it, even mapping it out, writing it out, playing with it, actually getting your hands and putting $5 or $10 or $15 or $20 into the pool at different ranges, at different concentrations, and seeing what happens to really understand what I'm talking about here. But where I'm leading you with this is that if we are expecting volatility to do this with the price, well, this tight range doesn't really make sense, right? We're going to go up, out of liquidity, or sorry, out of range, into range, out of range, into range. And every time we go out of range, we are not earning fees, right? So when do we want to provide a tighter range? Well, we would potentially want to provide a tighter range. Actually, just give me 1 second here. I'm going to cough. Okay. So let's see here. Where were we? Right. So if we are expecting the price, though, let's say that we have our two ranges of liquidity. We have the high and the low. Then we have our ratio here, and we expect the price to oscillate around this ratio, right? We expect it to come up into and do this over time. Then tighter and more concentrated liquidity makes far more sense, right? We are expecting the price to operate within a given range, which is the liquidity provider's dream. If you can get your liquidity to have the width, whatever that means, whether it is a narrow width or a very wide width of high and low prices, that will always be, within the range that price will move, you will always be earning fees. And the tighter the range that you can have that price move within while being concentrated in your position, the more fees you are going to earn with the same amount of dollars. This is really important to understand. Now, liquidity is its own science, its own art. Okay. And this is something that takes time to play with and understand. And so for all of you that are looking for opportunities with liquidity, understanding this is going to allow you to not necessarily find yourself in a situation where you had an unexpected, unintended, undesired outcome of possibly losing one side of all of your tokens, meaning you're left only with Titan X, or you're left only with Taurus, if that's not what you want, right? Maybe you only want, maybe you want both, or maybe you don't want just Taurus. Maybe your Titan X is near and dear to you and you want to preserve that. This is important to understand. Now, these effects can also be very beneficial in for buying and selling. Like you can actually sell and buy Taurus or Titan X by leveraging and utilizing impermanent loss. But we'll get into that another one. I want to bring this back to why it's important for Taurus and Unity. And this is why V3 was chosen, is because these protocols are designed to eventually come back up to this range and eventually stabilize, like I've shown here, around these ranges over time and just oscillate around that center point as it goes up over time. And this is another feature, not just of the ways people can leverage the internal system of Taurus and Unity, where you can earn more tokens, using your tokens as shares to earn in the system via staking or creating, but also for people that want to earn in different ways, or leverage their tokens to use them for different passive income opportunities, is liquidity providing is going to be a very interesting way for people to do that, where when the price is stable in the future on these ratios, people can utilize their Taurus and Titan X or Unity and Pulse X positions to basically earn from the volume generated through the use of these systems. And might I remind you that between both of these systems, there is $1 million currently in reserves that are used to create volume in the sense of buying Taurus or Unity. This means that these funds are volume that will be generating fees and given to liquidity providers. And in the future, as these funds expand and contract and be utilized in the various sizes that they, or the various amounts that they have in the protocols, then these fees are going to be generated for liquidity providers over time. So basically, this means that liquidity providers are going to earn fees from the buy and burn and the buy and build over time. And this is going to be a secondary income opportunity, or a yield generation opportunity for participants of Taurus and Unity. And if I bring this back to Unity, Unity is still in its supply distribution phase. It has not reached a point yet where it is appropriate to begin to build liquidity when there's so much supply expected to come out. And it seems as though that the market has not decided to do anything other than continue to sell right now. So there will come a time when both of these protocols are both doing the same thing. But for now, we are seeing them in different stages, being so early on in these protocols' lives. So that was a very, very long-winded way for me to describe all this, but it's incredibly important to understand for both of these protocols how you can use these systems, the way they operate, the way they're designed to operate, not just to earn from Taurus and Unity, but to earn from the market of Taurus and Unity as well. So let me just check in to see if that actually works and that actually makes sense. And see what you guys are saying. So let me just see here because I'm a little bit behind. Let's see. Yeah, amazing. Amazing to have you. I don't expect price to drop below all-time low, so I'm going to set a range to the upside as well and monitor it. Nice to have some visuals as you are. I know it really is. Yeah, I know the spaces are nice. I really do love them. And it's also simultaneously, I can just feel as I'm explaining, like what I'm saying is actually making sense just a little bit more. So yeah, I appreciate that reflection, my man. And great to see you here. Mr. Pulse Jitsu. Vast. Good to see you here, man. Hope you're doing well. We know you're here for the tech, and there's a lot of tech here. So glad to have you. And let me reply to Kesh here. So thanks for the explanation of LP range. Actually, Taurus and Unity are perfect protocols for LP range because we know exactly how many tokens come out daily, predictable price movements to an extent. This is actually so true. And this is one of those protocols, which is one of the only protocols this is unique in that sense, where you can kind of predict a rough amount of potential sell pressure. And when calculated into how much value that is, or even how many tokens that is, you can actually roughly predict in extreme scenarios, if all those tokens were sold in a day, exactly where the price would go. This is getting super nerdy, but you can actually do this. So this is a great observation. No Fear is saying, so the mid-range would be a better option as the price fluctuation settles down. Well, we can even assess this a little bit more. This is, let's go look at the chart here. And what I'm saying applies to Unity as well, right? Because Unity is also in V3 liquidity on 9mm with PulseX. So when we're looking at Taurus and Unity's liquidity, we can set different ranges based on our expectations. Now, let's make an assumption here. Again, just an assumption. Let's say that we believe that this here, or maybe this range down at the bottom, is going to be our actual bottom. We don't expect price to go any lower than this range right here. So what we could actually go and say is, okay, well, it doesn't make sense for me to provide Titan X lower than that range. So I'm going to have a concentrated range just below my minimum expected, maybe about 10% or so, or 20% below that range. But it doesn't make sense to go all the way down to 1 cent because I don't believe that the price is ever going to go below this here, right? So And if it does, I think it's going to come back up. So I'm okay with the risk of owning only Taurus on the way down to here, because I know that eventually this is going to come back up. This is all my assumption that I am building into this scenario here. And of course, there's a million different ways to assume and try and predict the way things are operating. But this is the assumption that we're going to build into this scenario. This is one way to view this. So again, we've built into this scenario that we think Taurus is going to not go lower than this. And let's also look at, okay, well, we know that the ratio of Taurus to Titan X is roughly around now 11 million to 1, with the difficulty being built in, which if we look at the price of Titan X, we can say that that's going to roughly be about $1.39-ish, $1.40. Let's go with that. The $1.40. This is where the median ratio would be in dollar terms if Titan X doesn't move. Now, normally we would talk about this in ratio, and actually maybe we should. Let's go talk about this in ratio. So let's build this into our scenario here. So let's say we think that, yeah, we're not going to go below the ratio that we have already experienced, and maybe just a little bit lower here. This is still a level of concentrated range for the sell side, right? Or for the buy side, depending on how you want to look at it. And now what we can say is, okay, for the Taurus side, I think that Taurus is not going to go up 2x above what this median ratio is in Titan X terms. And this is still a form of concentrated liquidity. But what we're saying is we believe that at worst, the price of Taurus is going to come down to here. And at best, the price of Taurus is going to come up to here before correcting in the reverse direction. And the entire time, this will be our range. This is an interesting way to do this, where we're looking at, okay, I don't think the price is going to go below here, and I don't think it's going to go above here. And the entire time we are going to earn fees. And if during that time, let's say the price comes up and begins to stabilize, what we can actually do is we can reposition ourselves to a different range. So now let's say the price has done what it's done. We've had our range over here. The price is now stabilizing. We'll now move our position from the low side to up here. Because now let's say we don't think that the price is going to go below 50% of whatever the ratio is. And we also don't think that the ratio is going to go 50% above what the median ratio is at that given time, which would bring us to about, I believe it would be right here. Let's even go 2x. And so what this means is we are now going to expect the price to go in this range, and we're going to be earning fees the whole time. Now, this is one way of looking at it. There are laddering. You can ladder your liquidity positions. You can do all sorts of crazy stuff to really make this work. But using this method of, okay, where do I think price is going to go? This, and understanding that it might go below or above, but it's always going to most likely come back to a range. This is a very nice beginning map of how to think about liquidity, so that way you don't end up losing all of one side of your liquidity and ending up with only Taurus or only Titan X when you intended to have some ratio of both and be earning the whole while you're holding and providing liquidity for both of those. So I know this is a lot, but liquidity is like one of the deepest things to really step into and begin to learn, because there's always volume, and he who understands liquidity earns from it. I mean, you're either the benefit of liquidity or you're at the expense of someone who does understand liquidity, right? Liquidity is everything. It's what creates the ability for these protocols to have any value, for there to be any market for it, to be able to be any fees, to have opportunities, so on and so forth. And that's why it's so important for both Torus and Unity to have essentially a built-in mechanism to consistently, every 10 minutes, build the depth, the size, the stability of the liquidity for these two protocols, right? Again, to go all the way back, if these protocols relied on user-provided liquidity, it might take a while for stability, meaning market depth, to ever allow us to oscillate back and forth in a tight range. But, or I should say, and what would be more likely is that we see very, very wild swings. We would see possibly the price go from all the way down here to all the way up here and back again and up and down. And we have these really crazy swings that, are just extremely volatile. But when the protocol owns the majority of the liquidity, it creates a foundational level of stability that most protocols or most tokens, most markets don't ever experience. And then when you add in the understanding of how this protocol wants to operate within a given range, right, over time, then the market can provide liquidity to support that specific range, which allows even more stability over time. It's a positive feedback loop in that sense, right? And the more stable these protocols become, the more incentive there is, or the more stable the incentives are, which provides, you could argue, more incentive for participation. More reasonable costs for participation means more funds coming into the system. More funds coming into the system is more guaranteed volume to liquidity providers, which provides the incentive back to the liquidity providers to provide that in the first place, right? And when people are providing liquidity using TORUS tokens, they're not using those tokens as shares to earn within the TORUS system, which actually benefits those who are not providing liquidity and using the system to earn from the system, equally as people who are not using the system. So it's a very balanced system where it's very when you take an action, you're giving to someone else. And when someone else takes an action, they're giving to you, in some way, shape, or form. It's not all sunshine and rainbows. It is still a cryptocurrency. It is still a token that is like the others, where when one person is winning, or when one person wins and extracts that win, it is, it does degrade the value of the token for others, which is still semi-zero sum. However, we've built into TORUS and Unity as many mechanisms as we possibly can to make I'm going to say the word delta, but the distance or the margin between when someone wins and another loses, instead of it being like when someone wins 100%, someone has to lose significantly. It's for someone to win significantly, another has to lose a tiny bit, and this isn't saying that everyone always loses when one person wins, right? But it's squeezing the gap, the distance between the winner and someone who watches that person win and what happens to them in that moment. That's really what's happening here in a nutshell, is we're trying to reduce the zero-sum game to as low of a distance or a delta between those two as possible, right? Bringing stability, bringing resilience and reliance that people can, even if they come late to this, still earn their way into, building their portfolios. And even when someone sells and the price drops, they can stay, they know they have an opportunity, and the system is designed to help them regain what they originally had and then some. So again, my monologues are definitely not getting shorter, but there's a lot to talk about here. And this is honestly, I feel like this is only the tip of the iceberg with this stuff. So what LP platform is used respectively in TORUS and Unity, and what are the fees paid out in? So there's two different, now the main LP in TORUS and Unity are different. So TORUS and TitanX are paired in Uniswap on V3. Unity and PulseX are paired in V3 on 9mm, but both of the pools are different in this is a 0.01% fee pool, and the TORUS pool is a 1% fee pool, which means that 1% of fees in the TORUS pool go to liquidity providers and 0.01% of fees in this pool go to liquidity providers. So this may be an opportunity for people to create a V3 pool with Unity and PulseX at a 1% pool if they so chose, which means that the volume they get through that pool is going to be 1% towards them versus being in this pool and providing and only getting 0.01%. You may want to consider that because this is how these pools are operating right now. So yes, awesome opportunity to learn here. And let's just do a quick shout out to buildthetech.com. These guys are the mastermind architects and engineers and team that brought TORUS and Unity to life. Without them, and their amazing team, their amazing craftsmanship, their quality of work, TORUS and Unity would not exist. I worked with an amazing designer to build out the logos and the design of the dApps, and bringing that to life could not have happened without Build a Tech. And here they are gifting 5 memberships to to 5 different of you viewers, which is amazing. These guys are phenomenal. If you have something you want to build, bring to life, at least go talk to them. They'll talk to you. They'll give you all the information they think you will need to understand what's going to go involved, the costs, time frames, and you're not just going to get a team. It's going to feel like you're part of a family. It really does. These guys are going to be people that I know and I'm connected to for the rest of my life. There are future things that I want to bring together, and I know exactly who to go to. And it really felt like we were a part of one family and team when we were doing this. So shout out to buildatech.com. I don't say that lightly. I don't say that as like a sponsored ad. I really do think that what these guys are doing is special and exceptional. And proof is in the pudding, so to speak, from my eyes. So anyways, though, thank you again for that. And Dan asks, please tell me if I'm wrong, but say someone created for 88 days with 30 million PLSX, roughly $1,000 at the time of creation. On day 88, the cost for staking is around $1,000. Doesn't make sense. Remember, this is an important, so you're hitting on something that is very, how do I say this? I don't want to overcomplicate it. And of course, my mind wants to overcomplicate things just for explaining the nuance when it doesn't necessarily need to be explained. So $1,000 is relative based on the fact that there are 2 different assets being valued. So let's go to Unity right now. And let's play with your scenario. So you have $1,000 in Unity, which is currently worth, let's say, 2,000. Let's go to 4,000. I guess that would be 2, 3, 4. 3,500 Unity right now. Okay, so right now, 3.5 thousand, basically 3,500 Unity costs 18.57 million Pulse X to stake. Now, here's where things get a little weird. Maybe at first, but they will make sense. There is a systemic ratio that is always increasing in difficulty within Unity. On day 1, 100,000 Pulse X created 1 Unity. And in order to stake that 1 Unity, you needed to pay 5% of whatever it costs to create that 1 Unity. And day 1, 100,000 Pulse X created 1 Unity. Therefore, 5,000 or 5%, right? 5,000 Pulse X was the cost of staking a single Unity. Now, over time, this increases every single day. So it gets 0.08% more expensive every single day to stake that 1 Unity. So if we fast forward to today, right, and we want to stake 1 Unity, instead of it costing 5,000 Pulse X, it now costs 5.3 thousand or 5,300 Pulse X to stake that Unity. Okay. This is important to understand, though. There are a few different things at play here. We have an independent value of Pulse X, and we have an independent value in dollar terms of Unity. And this is where things can get a little weird for people that are trying to understand this, where there is a systemic ratio that's always true, right? This is always going to be the case. But what happens is if Unity, right, goes up in value, let's say 1 Unity is worth $1 instead of 30 cents, right? Now it costs 11 cents to stake that dollar. Right now, because Pulse X is at the value it's at, but Unity is down relative to that value, now it seems as though, or it is the case that the dollar value of this 5,310 Pulse X is 11 cents, and that cost is 11 cents to stake 30 cents. But the ratio systemically does not change. And this is by design. This isn't something that was just arbitrarily just thrown out there and we're going to work with that and good enough. This was designed so that when we look at the amount of value that people are earning from the system on a daily basis, right? 94,607 tokens are being given out today. And that value, if we multiply this number here, of tokens that are distributed today by the current market price, we see that $29,120 is being distributed to everyone that is trying to earn, whether they're creating or staking, Unity, right? So what happens is this creates an effect where the lower that price goes. Now, stick with me here. I'm going to try and say this slow, but this is really important to understand. So when we are at this point here, this median point where the system is at its, the 100,000 to 1 ratio, where now what's true is that if you were to stake in USD terms, right, you would actually pay 5% of the cost of the stake, because this means that the ROI for creation and staking are equal, meaning that when you create with $1,000, you are going to, I should say, when you deposit $1,000 in PulseX to create, you are going to create upfront $1,000 in Unity and then earn on top of that, right? So the base value that you are creating with the PulseX is basically 1-to-1, right? And so when you earn on top of that, that's all profitability. This also means that because the ROIs are equal, when you stake $1,000 in Unity, you are actually going to be paying a real 5% in USD value in the value of what you want to stake. But what happens is, as we move down, and this opposite is also true, which we can get into here, as we move down away from this ratio, what is actually happening here? Well, this spectrum of price is the price in, or the value of Unity against PulseX. When the price goes down, this means PulseX is getting more valuable against Unity, or Unity is devaluing against PulseX, which when we look at the DApp, I'm not sharing this. I just realized that. So when we are looking at this median ratio here, this is where the staking fees in USD are actually going to equal 5%. And all this median ratio is going to make all these numbers that we talk about actually true. And when we deviate from that to the high or the low side, right, PulseX is increasing in value, or Unity is devaluing against PulseX when the price goes down. And the opposite is also true, where Unity is increasing in value against PulseX when the price goes up. So what this means, though, is that when the price comes down here, that Unity is devaluing against PulseX. I know I'm going to keep repeating this, but it needs to be said. So what happens is the ratio of tokens required to deposit in order to stake does not change, but the value of those tokens does. And this is really important to understand here. So as the token value of Unity devalues, what this also means is that the amount of funds coming in relative to value coming out is moving in favor of value coming into the system to support itself. And this creates an elastic band sort of effect, where the number of tokens that can be sold on the market and their effect on the price is diminishing as the price goes lower and lower. But because we are still bringing in deposits the value of tokens as if it's up here, we have a setup where the value coming in begins to start to be able to overpower the sell pressure that the system can see, meaning that there becomes a sort of elastic effect here where people are only able to move the price down so much temporarily before the system is able to keep itself at least floating at a certain range. Now, what happens here is if we are watching this price come down and people are thinking, this might be a price floor. I don't want to sell here. I'm going to buy some more to get in and stake, or I'm just not going to sell. What's going to happen is eventually we're going to see the trajectory change back up this direction. And the higher we go in price closer to this median point, the more the USD value of the deposit for staking goes closer and closer to 5% of the USD cost, meaning you pay less in dollar terms versus the dollars of Unity in value that you're trying to stake. Is this making sense? I'm going to come back here because we're just kind of going on a pretty deep monologue. Dan, let me know. I would love to hear from you because you asked the question. I'd love to hear feedback from you if this is actually making sense. This is a very important aspect of TORUS and Unity that really separates them from any other protocol. You can think of this like an elastic band. Now, actually, this is something that I want to break down a little bit more. Now, this is kind of the overarching structure of how Unity and Torus are designed. You can think of there is an elastic band that is constantly, and let me see if I can actually get a circle or something here that I can. Aha, there we go. It'll kind of work. Okay, let's go to here. So this is our elastic band, right? And what happens is, as the elastic band is always basically linked to the center point. You can think of the center point, this ratio that's going up over time, as like our bar, and it's almost like having an elastic that is hung on a bar, okay, or hung on a steel rod, so to speak. And as the price moves lower or higher, tension is placed on this elastic. This is the elastic here is in its natural state. This is the size that it wants to sit at. But as the price moves lower and lower, what we're going to see is the elastic band grows. And when the elastic band grows, more tension is placed on the elastic band. And if we know anything about tension, right, we know that if there is a fulcrum point here and the tension is caused by the direction that is being pulled this way, where is the point of relief want to go to? I know this is kind of a weird way to say it, but if we make an arrow, we can see that the tension is going to want to release back towards the center, right? The steel. The opposite is also true, where if we have our center of the bar here and we have the price go too high, the price is going to want to return. Now, the reason I can say this is because when price goes too high, the incentive systemically is to sell to compound, right? When we have the price go too low, the incentive structure flips to buying for the market instead of selling, and which will want to pull the price back up towards this steel bar or our median point here, right? But the difference is when we are at the high point here, there's only one incentive structure or one mechanism that brings the price back down to this steel bar, and that is selling. The difference here is that when we go to the low side, everything changes. Remember, there's only one mechanic bringing the price back down or relieving tension from the high side down to the low side. From the low side going to the upside, it's a completely different story. There is a buy and burn, there is a buy and build, and there is the market. All three mechanics, we can consider them as mechanics that are driving the price higher, which means as Torus and Unity actually go lower in price. This is what I've been saying from the beginning, that these systems are overpowered when they go to the low side because they have the most mechanisms, or they have the most number of mechanisms that are designed to propel its price back upward with just incentive and actual physical, let's say, the mechanics working in real time. So Torus and Unity are actually more powerful systemically when the price goes lower. Is this making sense? Okay, great. Great. Yeah, Scott is a wizard. I mean, all the guys are wizards. So many updates. Let's see here. Do you have any plans to make other DeFi projects in bringing more buy and burn pressure from Torus and Unity? Yeah, but those will take time. And these protocols are not a race. They never have been. They never will be. And so patience will be needed to look for the time when it's most appropriate to actually bring something else to help facilitate what Torus and Unity are here to do. And that might take a year, 2 years, 3 years. I don't know. It might take a few months. Who knows? We'll see. But when something is actually going to be built and it is not a when, but not an if or but more so a when of like when's the right time, or if the time is known, then that will probably be brought out to the market. I don't plan on keeping everything secret until the moment that it's literally about to launch. I do want you guys to be in the loop of when something is coming that is in the process of being built or is already, at least the start of that process. So, when people stop selling, staking fee goes down. When people stop, exactly. Well, the USD value of or relative to the stake that you want to make goes down, meaning it costs less to stake the same amount in US dollar terms. Mr. DeFi, I have no time for your perspective. Yeah, it's making sense. Thank you. Great. Makes sense. Thank you. Just love these two protocols. So much knowledge in this stream. I'm trying to give you guys that. And we have been going for an hour, which is awesome. And we've only really talked about liquidity, which, I mean, oh, there's so much in this. We can sit here all day talking about liquidity. And I would love that. I would actually absolutely love that. So I'm going to pause the liquidity conversation here. Thank 154 of you for being here, which is awesome. And if you haven't already, please go ahead and share the stream, whether it's on X or on YouTube, whichever platform you prefer to watch it on. Please share that. Would love to get the word out. Now, what I will invite you guys to do now is ask any questions that you have. It could be about the stream, about TORUS and Unity. And this is a section where I want to transition from me monologuing, just from what I've been monologuing about, to whatever you're curious about specifically. And if we want to keep talking about liquidity, that's great. But I would like to keep the stream maximum to about an hour and a half. I think there's a psychological visual thing that happens when you see a stream for 2 hours and you think, oh no, I don't know if I have 2 hours. But keeping it under 2 hours, let's do that. Thank you, Mike. Appreciate that. And Kesh, liquidity talk is awesome. Many folks wanted it, and it's great. I am more than happy to keep talking about it as long as you guys are interested in learning about and seeing the value in actually learning more about liquidity, because there's a ton to learn about liquidity. And one thing I'll add to this here for Unity and TORUS is that, as we put tension on the elastic band, so to speak, right? The band is stretched. We get the potential for correction. And as the liquidity is thinner, so to speak, meaning there's less dollars in liquidity, meaning there's, let's say, instead of $41,000 in Unity and $41,000 in PulseX, there's $400,000 in PulseX and Unity. This means that, there is the elastic band, so to speak, is thicker, which means that we maybe will see, instead of going all the way down here for the elastic band to be stretched, that the elastic band will only need to be stretched to here to want to return upwards, right? Or it will only want to stretch up to here to want to come back down, right? And this will be smoother, like I've been drawing here. One of the ways to think about this is with the brush, and instead of it being higher or lower, it wants to smooth out, and I keep opening the thesaurus for some reason, and it will smooth out over time to create a much tighter spread between the creation and the staking opportunities. So that was a hell of a monologue, but I guess that's the point of a stream, is to just talk and monologue and interact with you guys. So let me go back to the chat, and let's see here. What was what you wanted to explain about those cycles? Is Tornado USD cycles are the same as BTC cycles, but super fast and condensed? Oh, this is from the stream yesterday. This is from the question you guys asked me yesterday. Let me just think if I can remember it. Right. Okay. So just for you guys to be on the same page as I am from my recollection of what the questions were, it was, what was the thinking in designing TORUS and Unity's cycles of 88 days relative to, looking at it as though there's a halvening in difficulty or amount of tokens that can be earned. So there's difficulty increases and liquidity and how that builds over time. How are those all designed to be meshed together, and what did I see in modeling that made me come to those conclusions? And to be honest, it was something that I tried to simplify because there's going to be so many deviations from whatever I could expect to happen based on the market just being involved in dictating the price and changing things, and users interacting with this protocol differently than I would model out, right? What I did was I accounted for that, the unknowns, right? You just cannot know how the market's going to work with these protocols. What I did was I designed the buy and builds and the buy and burns to be able to receive more or less funds from the total deposits that are coming in, and simultaneously be adjusted higher or lower in the amount of the funds that they hold to be spent per day within certain thresholds. So I decided to do this specifically so that way, if the protocol needs more liquidity within a certain threshold, it can be set to receive more funds dedicated to liquidity, and simultaneously more of those funds can be injected within a range of 1 to 10% of the total balance within those contracts to be utilized specifically for buying and burning or liquidity. And this allows for this basically allows the protocol to evolve naturally however it wants to, given that, again, can't predict user behavior. There's a lot of supply coming out over the initial number of cycles, and we cannot be certain exactly how those cycles are going to really play out in terms of, how people are going to utilize the tokens. Are they going to use them for shares? Are they just going to sell them for quick profit? What are they going to do? And this allowed for these protocols to be guided in either direction in case they work in an acyclical nature, meaning like people are like the market is not necessarily operating in 88-day cycles or with the halvings. It's kind of just as people make decisions and as the macro market changes and as people's life situations change, they buy or sell, which change the conditions that are more or less appropriate to using funds for building up the protocol. That was kind of a word salad, but it's the only way I really know how to iterate that in a complete fashion. Long story short is the cycles were kind of secondary. It was just like the cyclical nature of the system is going to happen its own way, but it's really just going to be an evolving system over time. And I need the ability to adjust those parameters that or the funds that are used for the system in order to accommodate for people just using the system in ways that I could never predict. That's really it. And instead of it being every 4 years, it's every 800 and some odd days, 880, roughly 870 days, the halvening or the doubling in difficulty actually occurs. So hopefully that answers the question. And it was a great question too. So hopefully my internet is actually working well today. So Dan's also asking, the ratio of Unity to PLSX was 100,000 to 1. Do you think that it will always be our floor, or what is it that you mean about bouncing to and from that 100,000 ratio? So remember, when we are below the 100,000 ratio in PLSX terms, the incentive structure to the system is more so to buying, because in order to gain an advantage in the system, you need to buy the shares off the market at a discount, right? And when you stake, you are simultaneously putting funds into the system, which will be used to buy and burn or buy and build, buy and burn the Unity token or buy and build the liquidity, which is both helping the price come up. So again, this ratio is always increasing day after day. So every day that number of 100,000 to 1 goes up by 0.08%. So eventually that median ratio will be like 1,000,000 to 1 or 1,000,000,000 to 1. It's going to take a long time to get there, but these aren't floors, right? They're just median points where the system is going to want to be pulled towards. That may actually never, what may actually happen here is we may actually never see the price go above that ratio. Who knows? I know it's designed to bring itself above, and you never know how the market's going to perceive these systems and value them. And a lot of times what happens with new systems is if they actually are undervalued and they are systems that people can later see as a very valuable system, people tend to undervalue and then overvalue that same system. So, for example, let's say that Unity fits this criteria. So what that might mean is the price might come down way lower than is what should have happened if people actually priced in the same value that they'll see in the future. That will overprice things, right? The price will go lower than people expect. And then what will happen is the market will say, wait, there's value here. Boom. We're going to go way higher and overvalue this system. And then that same mechanic will bring, or that same effect will now bring the price back down. And you're going to have a much more volatile experience. Anything in between of, the system just kind of being somewhat valuable to some people to undervalued and overvalued to an extreme sense. All those are very real scenarios. But the system doesn't operate perfectly only if the price comes above this ratio again. What will happen is if the price only stays down here, you have to understand that the only tokens that are actually coming into supply are from the Unity pool. This is really, and the TORUS pool as well for TORUS. And this is really important to understand because the longer we stay in here, in below the range of this median ratio, the more tokens relative to the total end supply possible are being burnt. So remember that Unity is aiming to have, and will have around 125 million tokens in the end supply, same as TORUS, at the end of the day in 20 years, right? That's the end total supply. But what happens is if the price only ever stays down here, at some point, there's going to be more tension placed on the price because the number of tokens in supply are constantly being burnt, and there are only so many being created to compensate for that. So eventually, the theory here is that the price will eventually come and correct back up to this point as people see this deflationary effect happening, the difficulty of earning within the system, the competitiveness of the system, and they don't want to sell. When they don't want to sell, the price can only go one direction as people are buying and the system is also buying. That's the theory. Who knows what's actually going to happen here, but this is all the design of it. I shared it out to those I got started in so far, 3 people on board. Right on. Well, I appreciate you sharing it. It means a lot for you to have that much conviction to want to share it with someone else. So thank you. Mr. Kool-Aid, welcome. Good sir, good to have you. Thank you for the repost, Mr. No Fear. So let's see. Can you touch on how orbs will benefit the system in the future? Seems like they will be great for larger holders to trade without eating a ton of slippage. Yes. So the sky is the limit with orbs. And what I want to make sure that everyone is aware of, for someone that has no idea what the hell that means, is that if you are going to go to the TORUS or Unity dApp and you're going to click the create or stake button. Now, what I'm going to do is, give me 1 second here. I'm going to go to MetaMask. Give me a moment while I connect the right wallet. Let's go to this one. And so let me share the screen. So let's say we want to create. When I click create Unity, it gives me an option here, or gives me 2 options. One is the classic creation and one is the wrapped creation called an orb. An orb stands for omnipotent reserve bonds, which is a fun way of saying it's an NFT. It's a movable creation, meaning if you choose classic creation, your creation is fixed to this wallet and cannot be moved. And you, in order to actually move the tokens, you have to claim your creation or claim your stake, get the tokens, and then you can send them to a new wallet. If you choose to mint the orb NFT, or the option to mint an orb NFT and create a wrapped creation, you are able to move this stake or creation from wallet to wallet, similar to like an HSI or hex staking instance with Hedron and Icosa that was built for Hex. Same concept. Now, what this can allow people to do is to create a secondary market where if they want to sell their creation or stake and they don't want to sell on the market, they could actually, potentially sell these orbs on an NFT marketplace. They could sell them initially out of the gate. They could make a creation and sell them, taking into account some perceived notion of what the future value of that orb might be. And, they could potentially put $1,000 in or $100, whatever amount, doesn't really matter. Put a number of dollars in to make a creation, sell that on the market for more than it's worth, put that back into the system to do another creation and continue that process. There's also an unbelievable potential for a number of different use cases that have not yet been made that simultaneously could be extremely potent for these systems, which who knows if they will come to the surface at any point soon or not, or when they will. But they're latent potentials that I see that won't shock me when someone else builds or come out relative to this protocol as more use cases from the core of built for specifically Torus and Unity by the same team. That's all I'll say on that front. But the use cases here are endless. It's great for onboarding. If you want to say, okay, guys, friends, I'm going to get you in. You should get into this thing. I'm going to give you guys, or you guys are going to, I'm going to make these creations for you. I'm going to send you them and you can then watch them grow, blah, 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 blah. It's really easy to onboard people with this method where you don't have to get them completely involved. You don't have to go through the exchange process. You can literally say, I'm going to buy it for you. Here you go. I'm sending it to your wallet. All you have to do is just watch it. Done. Super, super easy. But again, the sky is the limit for potential with those orbs because they are NFTs, and because they're NFTs, they can be moved and utilized exactly like NFTs as well. Hopefully that answers the question, but there's honestly, this is getting into the what's possible territory more than what they will be great for. But yes, they're absolutely great for large holders to trade without eating a ton of slippage if people want to buy their NFTs or their orbs. And what's cool about this too is you actually have 14 days. Once your creation or stake is complete, you have 14 days for an orb holder to potentially list the orb on the market before they even get penalties. So what they could even do is they could have a 14-day window at the end of listing on the marketplace. And then on day 14, they take it down, they claim it, and do whatever they want with it at that point. But there's a ton of potential here. Let's see. Mr. Kool-Aid, I'm just going to read through your comments here real quick. Yes, one thing you have to understand is an orb made at 88 days is the maximum you'll ever be able to get shares at that time for 88 days in a range with those tokens. Exactly. So by holding that orb, you have a mitigation piece of the share system that can be moved and interacted with. Exactly. Let's see here. What else we got? You made a spaces a few weeks ago and explained how you created these systems to build whales, but that spaces are breaking up and we didn't get it all. Can you, in short, explain it, please? Let me save that for the next one because we're getting to the hour and a half point here. And this is a bit of a lengthy explanation, but I do want to save that for when I can just monologue and not feel like I'm overdoing it. I can feel like my voice is getting a little bit tired at this point too. And I want to save it. Greg is asking, I've done both a creation and a stake, but could you explain a bit more about the buy and burn feature, please? Absolutely. All right. Let's go to the Unity dApp. Where is my tab? There it is. All right. So burn. So the buy and burn is a fancy way of it's a fancy way of saying something like a share buyback. When a company has a share buyback program, they're basically buying them off the market and they're removing them from the market supply. So the buy and burn is similar to that. Now, the question you might be thinking, well, where do these funds come from? Now, if you look at this page here where it says $534,000, you're going to see buy and burn, buy and build, and fractal. So where are all these funds coming from? To understand where these funds are coming from, we have to look at the creation and the stake page. If you want to create Unity and earn Unity, you can see here that there's a little feature, a little function that shows, or a little tab that shows deposit. And you can choose to go between Pulse or Pulse X between these two deposits. If you want to create Unity, or even you want to stake Unity, you must deposit Pulse or Pulse X. Now, those tokens do not go nowhere, right? They go to the system. They go into the Unity system in various contracts, and it's divided up into 4 aspects. Right now, 64% of all funds go to the buy and burn. Again, I'm going to get to the buy and burn here in a second here, but I just want to explain where these funds are coming from, why they're ending up here in the first place. So the buy and burn is receiving 64% currently of the Pulse and Pulse X that is deposited for staking and creating. Currently, 28% of those funds goes towards building the liquidity. So these funds are used to actually build up the liquidity depth and the stability of the protocol. Now, the fractal here is basically taking a quarter of whatever is designated for the buy and burn, and it allows this to be received by the buy and burn on day 110 as a time vault, as like a reserve vault in case the protocol loses or has no funds. It's just to make sure there's always funds in the protocol. And this will build up every 110 days or over 110 days, release back into the buy and burn, and begin to rebuild again. Now, if you do the math, we've done 28% and 64%. That's not 100%. That's 84%. So, or 92, if I did the math right. 4.31% of all the funds that come into the system via staking or creating are going towards buying and burning if they come in the form of Pulse, or just burning Pulse X, meaning 4 cents on every dollar that comes into the system is contributing to burning Pulse X. So now we're up to 96.31%. There's 3.69% of all funds go to a no expectations address called Genesis, right? And that is exactly that. It is a no expectations address that gets 3.69% of the funds, and it can do whatever it likes with it. It could do something benevolent for the system. It can do whatever it wants. It's a no expectations address. But to bring it all the way back to the buy and burn, these funds come in the form of Pulse or Pulse X. And as you can see here, they're designed to, or designated to, buy Unity with Pulse X and buy Unity with Pulse. So how does this work? Every 10 minutes, this amount here is able to be called with a reward that you can get if you call that every 10 minutes, which will take this amount. It will first buy Pulse X, and then it will buy Unity with these funds. Once it buys Unity, it then deletes or burns these Unity tokens that it gets for this purchase permanently from supply. The same is true with the Pulse X, but the Pulse X doesn't have to buy Pulse first. The Pulse X is the second step that Pulse has to take. Once it goes from Pulse X to Unity, Pulse X just goes ahead and buys Unity with currently $10.59. And it then will do the same thing that these funds did, which will be designated to burning, so deleting the Unity from supply that it goes ahead and buys on the market. And this entire amount is designated to only be able to do that. Same with the fractal. These funds will be released into the buy and burn at a later date to be able to do the same thing. And these funds can only buy Unity and remove those tokens from supply, creating permanent deflationary pressure on this token. Let me just check with you that that made sense. Let's go. Unity.win. Welcome, welcome, welcome. Perfect. Yeah, I'm just going to wait on Dan. Where was it? Dan? I think it was Dan. No, or was it Greg? I can't remember. It's Greg. Right. So hopefully, Greg, that made some sense. What I'm going to do is I'm going to save the buy and build for the next time because they are different. This is a good distinction because the BNB, the buy and burn, has a fractal to it. I think it's better if they understand them separately. So they are separate. And I hope this wasn't too confusing. The main thing I want to paint here for both TORUS and Unity is that these funds in the buy and burn are only designated to buy Unity on the market and then permanently delete those tokens from supply. And we can verify that this is happening via our supply stats. We see that we have 144,000 Unity to date that has been bought and burned. for a total value of $43,000. And this is only going to tick up an increase in the future. And we can see the supply chart here where 28.4% of all tokens that have come out to date have been burned by the buy and burn itself. So hopefully that makes sense. Yeah, we could do flow graphs. I actually have some of those as well that I could probably do. They're a little confusing because they're kind of in depth, but I like that idea. Before you leave that, okay, say more. I'll wait. The ratio is almost 30-ish. I don't know. Are you referring to the price or are you referring to something to do with the burning? The SEC is outside? Oh, God. No. Oh, okay. You're outside. Okay. So what I'm going to do here, I'll wait for you to come on via your, obviously not your phone, and chart on. Okay. Yeah. If you can clarify what you mean, I'd love to comment on it. But if not, what we're going to do is we are going to wind down the stream because we've gone to an hour and 30 minutes, which is exactly how long I want the stream to be. So I'll give you another minute or so. But if anyone has any final thoughts or questions, anything you'd like to talk about real quick, we'll wait for Kool-Aid to get to his keyboard, then now is the time. But this has been an awesome stream. I know I'm saying that because I'm the one, and I'm the one talking, but I feel like we covered a lot of really great things. You know, liquidity specifically is such an in-depth, nuanced topic that I'm really glad we spent a lot of time understanding it, because it is what makes Torus and Unity so unique and so powerful as these protocols develop and mature over time. And it's what really separates them from many other what other protocol do you know of that has an automated smart contract designed to permanently increase the depth in the market? Pretty great. It's 28% burn, 27% amply, 38% stake. Yes, exactly. So, and okay, I'm glad that made sense. Thank you for letting me know, Greg. Let me just go to the Unity tab again. Yeah, so we have liquid supply, 4.7%. Burned Unity is 28.4%. Staked Unity is 39.4%. And supply in LP is 27.4%. So this is of the total number of tokens that have ever come into existence. I hope that's what you're referring to. I'm going to stop it there. 20% burn, 20% LP. I see what you're saying. Okay, cool. So my pleasure. And yeah, considering Torus didn't have a litmus test in front of it. Exactly. It was kind of just, it still is paving the way, versus Unity as a very different animal, because people can view Torus as a representation of what Unity might be like in the future, and then make plays based on how Torus is behaving and how the market is working with Torus. So it's really interesting to see all this work. So that's going to be it, guys and gals. Thank you so much for being here. This has been a fun one. And we'll continue to have more like this. I'm enjoying being back. You know, I'm enjoying finding a new balance. You know, as you guys all know, this place, the space, the sphere of crypto is can be all consuming and draining. And so finding a balance for myself personally, I would encourage all of us to find a balance in what, you know, doesn't drain us, but gives us, you know, motivation to come back and hang out together and get excited to be here. And, you know, I'm still finding a balance for myself too, of what I feel is a combination of most effective for, you know, being a founder, being the head of marketing, so to speak, getting the word out, and simultaneously not doing so much that I'm actually becoming ineffective. And right now I'm slowly finding my way of where is the sweet spot and how can I, you know, increase my capacity within that sweet spot without causing myself to be drained and, you know, need to take time away to figure out where the balance point is. So anyways, thank you guys for being here. It's been an awesome stream. Love each and every one of you. Appreciate all of you. And welcome to the age of Torus on Ethereum. Welcome to the age of Unity on Pulse Chain. And get excited, because I do believe that we are entering into a very exciting time in the coming months ahead. And this is not the time to start to sleep on what's happening here. We're going to have an amazing community to be along for the journey with. And I could not be more ecstatic and grateful for each and every one of you that are here. Thank you. Have a wonderful day, and I'll catch you guys in the next one very soon. Peace.